Hello, everyone. This is Brad Thomas, and welcome to the Forbes Dividend Aplenty, How to Profit from REITs as Rates Rise. I decided to use this topic today of dividends aplenty because I'm actually broadcasting this from Spartanburg, South Carolina, the home of the world-famous Beacon restaurant. And if you haven't been to the Beacon, there's a plate there you've got to try called Cheeseburgers Aplenty. And so I wanted you to know that's where we came up with the dividends aplenty. And so we're going to try to stack the plate with as much information today as REITs as possible. I'm not going to put any onion rings and fries on the plate. I promise you. We're going to try to spend the next hour talking about REITs, and hopefully you all benefit from this presentation. So let's move on here. Of course, my name is Brad Thomas again. I'm the editor of the Forbes Real Estate Investor. It's a monthly newsletter I have provided every month, and this is over 4 years old now. So I've been doing this now for at least a couple of years. I hope some of you joining are subscribers, and I look forward to the opportunity to work with you in the future. First off, I'm going to try to get through REITs real quickly. Some of you may be veterans in the REIT space, but some of you may not. And so I wanted to give you a really quick overview. Again, I'm going to try to keep this as quick as possible because I want to get into some specific details, some picks that we all can benefit from today. But let's just real quickly get into kind of REITs and why you should invest in REITs. First and foremost, REITs pay out at least 90% of taxable income in the form of dividends. Now, I know some of you invest in other dividend-paying stocks, C corporations, maybe master limited partnerships, MLPs, or BDCs, business development corporations. But REITs are unique, again, going back to that dividend component, because by law, and the law was created in 1960 in the Eisenhower administration, by law, REITs must pay out at least 90% of taxable income. In fact, most of them pay out 100% of taxable income. So that's one reason that REITs pay out very high dividends. The other benefit for investing in REITs are the fact that they're publicly traded. Now, there are non-traded or non-publicly traded REITs, but I focus almost 99% of my time on publicly traded companies that have this liquidity feature. That's really important to me, and I'm sure it's important to you. You can actually own real estate, buy it one day, and sell it the next day, or even in that afternoon, because these companies are publicly traded and offer that liquidity functionality. The next thing I wanted to tell you about is the REIT management teams. Again, these are publicly traded companies, so you have very skilled, very qualified CEOs, CFOs, CIOs, which is Chief Investment Officers. So I think that's another thing to consider when you invest in REITs today. Moving along, REITs also, again, going back to the liquidity benefit of REITs, you can see today that the size of the space is incredible. Over $1 trillion now in market capitalization in the whole REIT universe. There are 205 REITs in the FTSE NAREIT All REIT Index, and 192 REITs are traded on the New York Stock Exchange. We're seeing more and more REITs enter the space, and I'm going to talk to you today about some of these new REITs and actually some of these new sectors that I would have never thought about when I was in college over 2 decades ago. When we look at some of these real estate property sectors today. So we're seeing a tremendous amount of diversification, and of course this liquidity is growing to a very sizable amount today. Let's look at some of the yields today just for some comparison. We're seeing again, going back to FTSE NAREIT All REITs, yields 4.81%. Again, almost more than double that of the S&P dividend yields today. So going back to the next slide, yield comparison, stock exchange listed REITs pay out approximately $46 billion, and public non-listed REITs paid out approximately $4.5 billion in dividends. That's during 2015. And we're going to talk more about dividends today, but just wanted to make those comparisons. There's a lot of dividend growth in the sector today. And when we talk about where we are in the sector today, I'm really going to focus down on dividend growth because that is one of the most essential pieces of my research, and I think it should be one of the most essential pieces of your investment strategy today is finding those companies that have very sustainable dividend growth. There we go. Going back to the other way. Okay, so REITs and rising rates. First off, there's been a lot of questions about, and this has really happened beginning in May of 2013. When if you might recall, that's when Ben Bernanke was at the helm of the Federal Reserve, and when we started to even talk about the pullback in stimulus, the taper tantrum, if you will. And so, in May of 2013, that's when all of this drama started. And of course, the REIT market sold off pretty hard during that time. Since May of 2013, we've seen this really happen, from time and time again. 2014, we had a pretty good run, but then we had another sell-off. Again, going back to the fear of rising rates. And then we saw it again in 2015. We even saw it in 2016. Today we've already had several rate increases in the market, and we're going to see more of those moving forward. So why is that, and will we still see this continued kind of pull off or sell off when we see another modest rate increase? First off, earnings of listed equity REITs have been rising. Property occupancy rates could continue to rise if job growth and the overall economy continue gaining momentum, keeping rent growth on an upswing. Further improvements in business fundamentals could increase funds from operations. Now remember, funds from operation, that's the earnings metric that we use in the REIT space. We don't use core earnings because REITs are different because they do own real estate. So you have to factor in depreciation and a number of other factors to really provide a pure cash flow or funds available from distribution from these companies, from these REITs. So we use FFO. We even actually take it a step further and use AFFO as well, which really factors in CapEx and a number of other things that kind of even make it a better use of free cash flow from a REIT. And by the way, I discuss all of those metrics in my book, The Intelligent REIT Investor, which I'll talk to you about a little later at the end. First off, again, going back to REITs and rising rates, again, I think the biggest misconception is that when rates rise, that it's going to impact the profitability, the earnings for these REITs. And you can see here, this is a chart. And by the way, NAREIT is a great site to go to for research. That's www.nareit.com. This chart was provided from NAREIT, and you can see the historical FFO, funds from operation growth of all of these sectors, of all of these REITs. Now, of course, you can see the dip in 2009, the Great Recession, but you can see what's happened since the recession. Since 2009, we've had a tremendous upswing in the earnings for all of these REITs combined. Oops, I'm going to go back here. Sorry. Second, the Federal Reserve has stated that any decision to raise short-term rates will not be intended to slow the economy, but rather to reduce the degree of monetary stimulus. Following a long period of unusually low rates, the Federal Reserve Open Market Committee has begun moving towards a more neutral policy, but members do not anticipate a shift to a restrictive policy of high rates. Again, as long as the market, as long as the Fed continues to modestly increase rates, which is what we're indicating now, these REITs will be able to continue to generate the same level of sustainable earnings growth than we've seen in the past. There's no reason that will prevent that from happening. So quite simply, when rates rise, that actually allows the real estate market to adapt and increase rents. So a lot of these tenants that are in shopping centers and malls, in restaurants and office buildings, you name it, most all property sectors are actually going to see their rent increase during this rise in interest rates. Another thing I want to point to is that many of these REITs did cut dividends during the last recession, but since that time they've done a tremendous job at deleveraging their balance sheets and reducing their exposure to leverage, and specifically secured leverage, and really providing more financial flexibility. So what happened right up to the Great Recession, many of these REITs, of course, they weren't prepared for such a drastic pullback and not having access to capital. So now REITs today have much better access to capital, much more flexibility, and again, they've got much lower leverage today. So in other words, they have prepared for the market that we're in right now. Thirdly, history has shown that share prices of listed equity REITs have often increased during periods when the Fed shifts from a stimulus policy stance to a neutral policy. For example, listed equity REITs posted a cumulative total return of nearly 80%, outperforming the S&P 500 when the Fed raised its target for short-term interest rates from 1% to 5.25% in 2004 to 2005. The transition to a more neutral policy may lead to volatile share prices in the short term, which we've seen already. Thus, it should not be surprising if stock markets weaken from time to time as investors try to sort out the effects of both changing interest rates and changing economic fundamentals. Moreover, the experience from spring 2013 through mid-2016, when yields on the 10-year Treasury rose quickly from 1.6% to 3% on concerns about the Fed raising short-term rates, only to fall below 2% again, counsels some caution in extrapolating higher long-term interest rates far in the future. Again, I can't be a market timer here, and all we can do is look at the macro level events and really focus more, and what I do every day is focus more on the ground level. I like getting into the weeds and looking at these stocks and finding out where we have the value, where we can see the best opportunities for growth and really specifically dividend growth. Now this chart here shows the dividend growth. Again, I've provided you with the previous chart of FFO growth. This chart again provides dividend growth, and you can see a large growth in dividends. The big spike we saw was really related to some special dividends that went out in 2015-16. So that's more of an anomaly if you're concerned about the fact that maybe in 2016 there was a dividend cut. So we've really had very strong dividend growth coming out of the recession, and we believe it's going to continue going forward. Mortgage REITs are better positioned than equity REITs, says who? Now, I've provided this chart because I get this question almost daily, if not weekly, when I have a number of subscribers and followers and readers ask me about investing in mortgage REITs. And I put together a little historical analysis that might give you a little idea of my really fear of mortgage REITs. First off, this shows the rent growth. The rent growth has remained modest, if not solid. And so this is just really shows from all the sectors, office, industrial, retail, that, again, the rent growth coming out of the last recession. Now let's take a look. This chart here shows the equity REITs, which are in the blue shaded bar, and the mortgage REITs, which are in the red shaded bar area. And you can see over in the period of the 1970s, 72 to 79, and this goes back as far as the data was obtained from NAREIT, again, the source of this data, you can see that equity REITs return on average, and again, during the 70s, 13%, mortgage REITs 5.9%. So again, it's very favorable, double the performance in the 70s. Now going back to the 80s, and the 80s was a great time for me. That's when I graduated from high school and college. Wish I could go back there. But I also wish I could go back there to invest in REITs. You can see here in the 1980s, equity REITs delivered 16% total returns during the 80s and 8.6% during that same time for the mortgage REITs. So again, equity REITs definitely outperforms, almost double the performance of the mortgage REITs. Let's go to the 90s and take a look. You can see here that, again, equity REITs delivered 10% return during the 90s, and mortgage REITs delivered 6% returns during the 90s. So again, I'm just taking this decade by decade. Now let's go up to the Great Recession, we call it, last recession. You can see equity REITs delivered 13.5%. Now we had those two tough years, 2007 and 2008. Again, those were outliers. I don't think we're going to see another Great Recession. We're going to see a recession, and we certainly want to prepare for that. But again, I think those two periods of 2007, 2008, so if we took those periods out, equity REITs would have outperformed. But again, in all fairness, mortgage REITs did perform better during those periods. It was tough for not only REITs in 2008 and 2009, but anything tied to the financial sector in those periods really took a beating. So, I don't really like the fact that some people like to pick on REITs because there were banks, there were insurance companies, or any company that was tied to finance obviously was devastated. So now let's move into equity REITs since 2009. You can see that equity REITs have returned an average of 15.8%. Now, this data was obtained a couple of months ago, so I haven't updated this through today. But again, in general, you can see that we've had a very strong performance in this bull market for equity REITs since the recession. Mortgage REITs, not so favorable, actually pretty good. You still see the volatility of the mortgage REITs, and again, in those periods, you see more bad years than good years. So what I'm trying to suggest here is that equity REITs are more stable. If the investor, I'm not telling you that mortgage REITs are bad investments. I think mortgage REITs are more complicated investments. I typically don't recommend mortgage REITs for the average investor because you really have to be more of a trader. You have to be really know when to get in and get out of these companies. Whereas equity REITs, because of the long-term contractual lease nature of these leases and the fact that they're brick and mortar versus paper is what mortgage REITs are, you've got a really more predictable, investment thesis there. So from 2010 to 2016, you can see equity REITs again have outperformed, the mortgage REITs. So again, I would not say to you to get out of mortgage REITs. We own a number of commercial mortgage REITs, which we'll talk about here shortly. I think that's a safer vehicle today than the traditional residential mortgage REITs, primarily due to leverage, and because the residential REITs obviously have higher leverage, and that's what generates the higher yield. So there's just more risk. I don't think the return is justified for mortgage REITs in general. But again, if you're involved in this sector on a day-to-day basis and you understand it, certainly is an asset class that you can invest in. But I prefer to focus on the core food group, which is equity REITs. And here's a list of sector by sector. You can see a number of these names that are beyond the traditional property sectors that we're all familiar with, being industrial and apartments and shopping centers or retail. There's just a wide variety now of companies that you can invest in today, and the REIT laws have really allowed an enormous amount of ways for investors to capitalize on all of these various property sectors. And we're going to talk about some of these less traditional sectors today, and I've had to become educated in a lot of these sectors that, again, I'm not as familiar with. And so let's start here, and we'll call this phase the what's hot and what's not. Again, I wanted to spend a little time, really more time, talking about these individual companies and hopefully providing you with some actionable information on some real estate that you can own in your portfolio. So first off, I want to talk a little bit about net lease. Actually, I wrote an article on Forbes.com, I think on Monday, talking about some of the net lease REITs. And just to remind you, a net lease REIT is a company that owns net lease properties. So what is a net lease property? It's a freestanding building like a Walgreens that you probably see driving to work or on the way home from work, or maybe a FedEx distribution building. 4 walls, 1 tenant. And what's the reason we call these net lease is because when you define a lease, you can either have a lease that's a gross lease, which means that the landlord is responsible for all of the expenses, the taxes, the insurance, the management, the maintenance, the exterior walls, the roof, even the landscaping. So a gross lease is basically the landlord is charged with all of those responsibilities. A net lease, or really what we would really call a triple net lease, because the triples are taxes, insurance, and maintenance. So a triple net lease provides that the tenant pays for all of those operating costs. So when the landlord gets a rent check from, for example, a Walgreens, that there are no expenses taken out of that. The landlord gets to keep 100% of that rent and apply it to debt service if they have debt, and the rest they can put in the bank. And so net lease is really more like a bond. I'm not going to call it a bond, but it's certainly bond-like. And so now we're seeing a very large, growing sector in net lease. It's interesting that, 5 years ago, even 6 years ago, many of these institutional research firms didn't even cover net lease. And really, thanks in large part to the growing monetization of a number of these non-traded REITs, and the chase for durable income for retail investors today, this sector has grown into a pretty substantial space. And so you can see the list here of companies. There's actually, this is not the entire list of net lease REITs that I've showed you here, but most of them are here. And we're going to be talking about infrastructure REITs in a minute, but infrastructure is really almost a sub sector within net lease. They just provide net lease type long-term lease structures to those companies. So I'm going to tell you about a couple names. You can see, this by the way, this data came from our newsletter we just published yesterday. Again, the Forbes Real Estate Investor. We have all of these sectors covered and more. But net lease, what I do is at the end of the newsletter, we provide a ranking, and we obviously have our recommendations on the far right corner, and then we have the color chart indicates the current price differential to the fair value price. So obviously the color coded area provides the difference between the 784 price, which is the current share price, and our target in the case of Spirit. Now, we don't have a buy on Spirit, even though it's trading at one of the lowest valuation ranges in this space. I've just been very reluctant to get into Spirit, given the management changes and really the volatility within that space. They have had to cut their earnings back in the last quarter. So that's one reason we've got a sell on Spirit. There's a potential for a dividend cut at Spirit as well. So I've really stayed away from that name. I think there could be more pain ahead. So we've got buys on those other names. I want to talk to you now about a couple that I like, which would be STOR Capital. STOR Capital, again, we've got this in the newsletter, is a buy, a strong buy. STOR, as you probably know, recently Warren Buffett, or really Berkshire Hathaway, took a stake in STOR of around $377 million. STOR is a net lease REIT. They're a little different from the other traditional net lease REITs like Realty Income and National Retail Properties, because they invest in really what I would call more non-investment grade properties. They really gravitate towards not necessarily franchisees, but companies that are just below investment grade rating. Really to mitigate that risk, though, in terms of the credit ratings of the companies, what STOR does very well, and I'm sure Warren Buffett and his team at Berkshire understands this quite well, is STOR does I won't say a better job, but they do a more detailed job in terms of their acquisitions and their investment strategy. They almost always make their tenants provide P&Ls for every individual property, so they know exactly how each property is performing, and so that gives them a quite a bit more of risk management within their investment profile to be able to buy properties. Certainly there are going to be defaults, but when there's a lease default with STOR, typically that real estate's pretty strong because they already have a history of their performance at that location. So say, for example, there's a restaurant that goes bankrupt, and STOR has this particular property. They already know how that property is performing and how they can get a new tenant or new operator to go back and lease that. So I think that's one of the STOR's, I guess, primary differentiators, is how they make their investments today. And again, you can see STOR, they're paying about just at a 5% dividend yield today. So that's very attractive. And one thing I really like about STOR is they have the lowest payout ratio in the net lease space, around 65%. So there's a wide margin of safety in terms of their dividend. And again, this is definitely a buy that we continue to have on this company. And I think they, with Berkshire Hathaway's recent investment, it really validates really not only the strength of STOR, but also the strength of the brick and mortar model in retail. Another name I have on the list that I've written about quite a bit is WP CAREY, WPC, based in New York City. Again, this company does not have the same growth forecast as STOR or some of the other net lease REITs. One thing that I really like about this company is that they have really two portfolios that they own within their investment management model, which is their non-traded REIT model. Those are referred to as CPA 17 and CPA 18. At some point, and I believe either this year or next, again, I don't know specifics, but it's certainly the time is right for CPA 17 to be monetized, and which would mean the publicly traded company, WP Carey, would acquire that property. That would create, I think, some very attractive growth opportunities. We saw that happen in a previous deal that CPA did just a few years ago, and it had a significant impact to their earnings and dividend growth. But the current dividend is safe right now. It's about a 5.5% dividend yield today. And one thing that the company recently did is they decided to move out of the investment management business. It was creating some overhang on the stock price, and I think now that should be a benefit. And Carey has performed well year to date. They don't have the retail exposure that Realty Income and National Retail Properties has. So this is really primarily an industrial play and an office play. And obviously they've got the international European exposure as well, which is another part of their diversification strategy. So like Carey. I'm going to move now over to the infrastructure. We actually just decided to include infrastructure REITs, that category, if you will, in the newsletter, the Forbes Real Estate Investor newsletter. And you can see a number of companies that are on the list. Again, going back to my previous thoughts on the traditional versus non-traditional real estate, and when you look at infrastructure, you see a number of property sectors that I would have never imagined, that I was going to be covering when I was in college, talking about, commercial real estate. You've got cell towers on the list. That's Crown Castle, ticker CCI, and American Tower also. You've got Core Energy, which is, again, pretty easy to tell what they do. This is an energy REIT. They invest in energy-related products. That company had a really nice run last year. It was actually one of my top performing picks in 2016. And then more recently, I've been covering companies like Landmark Infrastructure Partners, and which is actually going to be spinning off there into a REIT. So that's why we went ahead and left that on the list. And we've got UNITI Group as well. I'll talk to you about UNITI in just a second. And then we've got Hannon Armstrong, which I've been covering for quite some time. And Hannon Armstrong is really, I kind of refer to them as the clean energy REIT. Now, they invest in solar and thermostats and a number of, sustainable energy products. And so we've got a buy on that company as well. So we're going to go to the next slide here. And I think infrastructure is going to be really a good bet to be in. I mean, obviously the cell towers have performed amazingly well year to date and really for quite some time. UNITI is a little different. Now UNITI does report earnings tomorrow. That would be August the 3rd. So I'm looking forward to that. We just initiated coverage on July the 11th on this company. Now this is a higher risk bet. It's really what I would consider more of a speculative buy. We now have a portfolio called a high alpha portfolio. I included UNITI in this. And typically what I look for with these high alpha picks are companies that I believe could generate around 25% annualized total return. That's a high mark. And we certainly believe that UNITI has the potential to generate some of this outsized performance. It's probably going to be easier because UNITI has such a high dividend. They've got a 9.3% dividend yield right now. Some of the concerns with UNITI is the exposure to Windstream. That was at one point their only tenant. They have been diversifying now into many other major wireless carriers. So UNITI is definitely something that's got more risk. We do have, again, it's more of a speculative buy on it, but I think it's going to produce some really attractive returns. And but again, I always like to caution investors. This one is higher risk, and we try to provide the right the right messaging to investors in terms of how the risk profile of these companies. Now let's move over to healthcare. Healthcare has been an interesting space, and we all know what's going on in the political arena today. And certainly that's had some impact on a lot of these healthcare REITs, more specifically the skilled nursing REITs. I'm sure a lot of you either own or have considered owning shares in Omega Healthcare Investors, which is 1, 2, 3, 4. That's our fifth REIT in the healthcare list. we have that as a SWAN. That means it's a sleep well at night company. So we, in the newsletter, we rank all of our REITs based on either they're a SWAN, which is another better way to put it, maybe a blue chip. So we've kind of gone through and rated all of these REITs in our REIT lab in the newsletter. SWAN is Omega is a sleep well at night REIT, even though there has been a pretty substantial beatdown with the market. Omega is a pure play skilled nursing REIT, and we've all seen the volatility in the skilled nursing space today, and it really boils down to the operator risk that is within these skilled nursing, the business model of skilled nursing and the government pay and the new bundling packages. And really what's really hurt this sector the most is really the regulation and the complication. And a lot of these companies, operators, if you will, have had had to settle with the Department of Justice. And actually, on the last earnings call, I just wrote about Omega. There were 3 companies in their top 10 list of operators that have had to are in process of dealing with some of the Department of Justice fees. And so, but we've maintained a buy on Omega. One thing I do is I like to stay in very close communication with most all CEOs. I had a conversation with Taylor Pickett at Omega Healthcare just after the earnings call last week, and kind of walking through some of the volatility. But Omega has, again, it's very safe in our view. The sector itself is still under some pressure, but today I know I want to talk to you about another stock in healthcare that you may be familiar with, New Senior Investment Group. Again, this is another speculative buy. New Senior. First, I want to tell you about the risks. Then I'll tell you about the returns. The risks in New Senior really boil down to 3 things. First of all, it's externally managed. One of the few externally managed healthcare REITs. They are actually managed by a larger company called Fortress, based in New York, which I'm sure you may be familiar with. So one of those risks is they're externally managed. Number 2 is the leverage. They have really significantly more leverage than their traditional peers. Again, that goes back to their external management. Fortress is a private equity firm, and typically private equity firms like to employ higher leverage or more leverage to generate higher yields. So that's certainly been part of the risk factor. And third is the concentration. They have a tenant concentration risk, which is their top tenant is Holiday, privately owned company. That, again, this is senior living, not skilled nursing, but senior living. And so Holiday, and those really Holiday, the concentration, the leverage, the external management, those all really have been somewhat of an overhang on shares in New Senior. But one thing, I guess, in regards to New Senior, that the return, going back to the return, is we do see that the company today has an attractive dividend yield today of around 12%, actually 10%, sorry. And the valuation is one of the lowest multiples, around 10 times AFFO, or funds available from distribution. But the dividend is tight. You can see that the adjusted funds from operations per share is about $1.04 and 17. That's based on forecasted AFFO, and the dividend is 104. So basically, there's really no margin of safety with the dividend today. So it is more speculative, and buyers beware. But again, this is another high yielding company that a REIT that we do have in the portfolio. I've written about this extensively. I believe that at some point, New Senior will be acquired or they'll go private. I've hinted around at some REITs that I believe could potentially make a run at New Senior, but it's going to be harder for that because of the higher leverage. So I think it's definitely going to be maybe a stock transaction. But we're starting to see more of these REITs like Ventas that have improved their cost of capital. Multiples are now moving in line, and so I think this is going to be an interesting name to watch. But again, I would never advise somebody to buy a REIT or really any stock based on the potential for M&A because we just never know. Again, there's Omega Healthcare. I've forgotten I have that one in there. You can see that $31.59 a share, definitely trading below the intrinsic value of the stock. Omega's multiple is about 10 times, 10.2 times, and the historic valuation for the company on an AFFO basis is around 12 times. So it's trading a couple turns below kind of normal trading ranges. We'll probably continue to see this type of overhang for a while, at least until we kind of get some direction with this healthcare situation. But I think the dividends is definitely on safe ground. Finally is Ventas. I wrote on this company just a few days ago. They have already completed earnings, again, like Omega, and they really had a great earnings quarter. Deborah Cafaro, the CEO of Ventas, is one of my favorite CEOs, and she's done a great job. I think, given her a lot of credit for the spinoff of Care Capital, which she really beat all of the other healthcare, the diversified healthcare REITs to. We saw Ventas do this spin with Care Capital Properties. Again, that's the skilled nursing business. We saw that about 1.5 years, 2 years ago, and then we saw what happened with HCP, their competitor, with that spin, and then we saw what happened with Welltower, HCN. So Deborah Cafaro is just an exceptional, in my opinion, risk manager. She now has this business structured with multiple levers. They are diversified. They've got medical office buildings. They've got life science. They've got senior housing. And again, they don't have skilled nursing, and they have hospitals as well, which is a partnership with Sam Zell. So Ventas definitely a buy. I think that this company will still continue to deliver, good growth in AFFO as well as dividend growth moving forward. Okay, self-storage. Self-storage is an interesting sector. I haven't really covered this sector in a while, except just a few days ago I wrote a quick little update for Forbes magazine that will appear in the upcoming Forbes edition. But essentially, where I'm at with self-storage today is, if you would have asked me back in January, should I own shares in self-storage, which we do, by the way, but if you would have asked me if I would have initiated a position in self-storage back in January or December of last year, I would have said probably not, because of the pricing. It was getting really expensive. So now we've seen self-storage pull back fairly considerably. I'm going to show you one company here in just a minute. But what's happened essentially is, going back to kind of the macro conditions in self-storage, supply and demand, we've seen a lot of development. Most all of these self-storage REITs have some type of development model, either internal or external. And so we're seeing continued growth in the new supply in self-storage. And there's actually a commercial mortgage REIT, Jernigan Capital, which we cover, that finances the self-storage REITs. So again, that's all going back to the substantial growth. So what's happened is a lot of in terms of acquisitions, since coming out of the recession, a lot of these self-storage REITs have acquired a lot of these kind of trophy assets in major gateway markets. So it's harder for the self-storage REITs to find investable properties today, certainly in the gateway market. So they're having to dip down into the secondary markets like Greenville, South Carolina, where my hometown, or Charleston, South Carolina, some of these other somewhat secondary markets. So, and it's harder for them. Development takes time because they can't go out and acquire as robustly as we saw in the last few years. So earnings have been somewhat slower. We don't see the double-digit earnings and dividend growth that we saw really in the years after the recession. So, Extra Space has always kind of been my top pick in terms of their fundamentals. They have always really had the best overall fundamentals. I still own Extra Space. The reason we don't have a buy on is, again, valuation. They're you can see, just 5% below my fair value, so we're waiting for a pullback. But I do like CubeSmart, and we'll look at that and show you why. You can see CubeSmart. They just announced their second quarter earnings. So we already have that clarity in terms of their second quarter. They got $24.60 share price. The company's had very consistent, really double-digit growth in the previous years, as I just mentioned. Again, we're not going to see the same dividend growth that we probably saw in the previous years. But again, we've seen in terms of pricing, the margin of safety, this company is definitely below the intrinsic value of the stock. And so Cube is probably right now today, my top pick based on price. Again, I still like Extra Space. They've got a great management team. Public storage has always been expensive. I know some of you had asked me about that, but it has come into a reasonable valuation range. So public storage could be a candidate as well. So I think I'm going to go down. I got a couple more stocks, and then I'm going to try to wrap up Q&A. So let me certainly want to get to your questions. So malls, real quickly, mall REITs have been beaten down. I've got buys on every mall REIT. You must think I just love malls because all you see is, green lights here. But in reality, you got to be cautious in malls today. What I'm recommending is focus on quality companies. The only reason I have CBL on the list is it's a speculative buy. We put that in the high alpha portfolio. Again, that's the portfolio that we're trying to beat 25% annual returns. So CBL certainly fits into that bucket. But in terms of right now today, we only like the higher quality names. You can see I've got a strong buy on Simon. I'm riding on Simon tonight. The company, they've already came out with their earnings, had a great earnings quarter. And, David Simon really seems to be executing this company very, very well, the CEO of the company. And so I think we're going to start seeing this bounce back, some of this retail. But again, I'm not going to call it the bottom today. And we'll talk about that. I think I saw a couple of questions in Q&A, so I'll save it for that. But Simon is, again, looking at the price of the company. They've been beaten down. This company has a very strong trajectory for growth moving forward. Again, retail has been beaten down pretty hard. But again, you've got an A- rated company, one of the few A-rated companies out there that has this type of potential dividend growth. But also look at the pricing today. So Simon's definitely a top pick here. Tanger's another name. I'm sure you've heard me talking about Tanger or reading about some of my articles, Tanger, quite a bit. Of course, they're right here in North Carolina, close to me. They're based in Greensboro. I think the outlet sector has really been, misinformed, if you will. There are no department stores in outlets, and so while you may see some, the Sears and JCPenney's overhang continue in the mall space, Tanger doesn't have that overhang. They do have some of the other specialty retailers, specifically apparel retailers, that are of a concern, and rightfully so. But looking at the valuation today and really the fundamentals of the company, their earnings were really, really strong. I definitely want to maintain a buy on Tanger Factory Outlets. And I think I have two more left, and we'll get to Q&A. Hopefully I'm staying right on time. I've got some specialty REITs to talk about today. And again, there's more than on the list, but in our Forbes Real Estate Investor newsletter, you can see some Farmland Partners, Iron Mountain, Gladstone Land, Lamar, Outfront Media, Armada Hoffler, American Assets. Those are all kind of unique companies, so we throw them in the specialty group. Farmland, I've written about this recently. I moved this over to a spec. They just really had some bad earnings with Farmland, and I've really, frankly, been disappointed in the integration of the company they acquired. And again, this is the bottom line with Farmland is the dividend is not as safe today as it was 30 days ago, 60 days ago, or 90 days ago. So I'm a little concerned with Farmland. I've moved over, pivoted, if you will, to Gladstone Land. Yes, Gladstone is externally managed, whereas Farmland is internally managed. But I think Gladstone has the best growth potential moving forward. Again, I would wait a little bit. I'm 6%. Today, the stock's trading at about 6% above my fair value price, but we went ahead and included Gladstone to the list. Outfront Media is another one I've written about recently, that Outfront and Lamar both in the billboard business, and certainly a new sector that you should take a look at, and we provide that research as well. Last but not least, Iron Mountain. Obviously, they do the paper document storage. They also had a really good second quarter earnings results, and we're maintaining a buy on Iron Mountain. I really like the fact that they've moved into data and really started to provide a really more diversified platform while maintaining their legacy brand of Iron Mountain. Commercial mortgage REITs last, I guess, is we've got a number of those on there. I mentioned Jernigan Capital. We like LADR. the best right now. Again, based primarily on valuation. But again, the dividend yield, Ladder's 9% dividend, just over 9%. We believe it's sustainable. And again, Ladder's internally managed too, the only internally managed commercial mortgage REIT. So in our newsletter, we've got a list of, our durable income portfolio has done very well this year. We're just over 7% year to date. We've got, quite a bit of diversification in the portfolio. This is our top picks, in that durable income portfolio, one of 5 portfolios in the newsletter. And you can see these are our top picks. So I believe now we're going to move it over to Q&A. Again, trying to stay on time. And first question I have is from Richard. Richard, what percentage of total investments should a newly retired person have? So Richard, again, first disclosure or disclaimer, all investors have his or her own risk tolerance levels. So I don't know specifically your investment portfolio or what your investment strategy is. But I will say, in general terms, I recommend somewhere between 10% and 20% of a portfolio in REITs, and not to be confused with real estate, because I'm not referring to a house, your house, or a vacation house, or rental properties. I'm referring to your investment portfolio. And again, I'm not a big fan of mortgage REITs. I think if you're a retiree or soon to be retired, or you're newly retired, as you said here, I would say 10 to 20%. I would move closer to the 20% because we're still in this bull market. I think we're going to continue to the Fed has really worked to our advantage in terms of the modest rate policy that we're seeing today. And the clarity that I see is over the next year to 2, possibly 3. I can't go way out, but I think we're going to continue to see the 5-6% growth in share price, and of course dividends add that in. So 10% a year is kind of the target, unless you're in that high alpha portfolio range. But for the retiree, and hopefully my mother's listening to this webinar, I've recommended to her around 15% of her portfolio in REITs. Next question, it's an E. I don't know the last name, but it is there a subcategory of REITs that focus only on nursing homes or everything within healthcare? Yes. So I think again, Omega Healthcare is kind of the closest you're going to get with skilled nursing. Again, that's a specialized. There's not really a pure play name other than Omega, and of course, Care Capital Property Trust, which has announced a merger with Sabra. Sorry about that. There's some debate whether or not this merger will happen. There's been a couple lawsuits filed. I've written about this. But look, I would say overall, the best healthcare REIT, and I've made no bones about it, the best healthcare REIT, if you're going to have access, Ventas is the name, because the company is diversified in all those spaces. Yes, you can have MOB REITs. Obviously, I couldn't cover all these on the call, but MOB is kind of MOB, medical office building, that is. That's the lower end of the risk curve, and then skilled nursing will be at the higher end of the risk curve. If you want to be more tactical in your exposure in healthcare, you can certainly go in and own Omega and MOB, which is, say, a Healthcare Trust of America, and maybe a National Healthcare, which is NHI. But I would say the safest bet is Ventas, or build your own portfolio, and we certainly do that, in our newsletter. By the way, I did want to mention the newsletter. We've got a rate today, and again, I'm just we're $99 just for this promotion, $99 a year. Typically, my newsletter runs about 25 to 30 pages, so we provide a lot of information. I put a lot of data in the newsletter, and we try to make it data driven. We also provide quarterly ETF information as well. That was one of the questions here I'm going to get to with Randy. Randy, top REIT ETFs. We do a quarterly kind of REIT ETF update, if you will, and we're doing that in the upcoming edition. That'll be the September edition. August just went out, and I like to do this because it gives me some good comparison benchmarks with how we're performing with our portfolios. But obviously, with an ETF, Randy, you're only going to get average. You're not really getting in for above average. but you're also probably not going to get below average because you're just buying typically most of these ETFs by the index. Vanguard is kind of the big name that everybody's familiar with. That's VNQ. Again, the company has not outperformed. They haven't underperformed. They own so many stocks. I forget how many total, but again, very diverse. Simon is one of their top names. So you can see just when you look across all of the ETFs today, most all of the big names have exposure to Simon, typically 6, 7, 8% exposure to Simon. So that's, obviously impacted some of these ETFs in that way. But, I don't ever tell people not to invest in ETF. That's why we include that in the newsletter, because some people just don't like picking stocks. They want to buy ETFs. I get it. And really the market is going to people wanting to just buy these indexes. So I think it's important, and that's one reason I decided to include that. Tim's got a great question here. Tim says, the market cannot keep going. What are the best defensive stocks? Tim, you hit the nail on the head. I mean, I think that defensive stocks is really where capital needs to be deployed today. And I've written about this a lot. Don't be too cute when it comes to investing, not only REITs, but just investing in general. You've got to play offense and defense, and, defense does matter. So what we've done is put together a rating we call the Rhino rating, where I go into each REIT and we come up with a scoring system for each REIT based on a number of rating fundamental characteristics or attributes, and we come up with a score of those REITs. And again, it has nothing to do with price. This has to do with quality. That's balance sheet. That's dividend safety. That's dividend growth. That's management. All those factors that go into really the Rhino rating. And so take a look at that. We have those scores in our newsletter, and definitely defense is definitely the way to go. And I think you'll be really happy with buying those most defensive names. This is Keith. Keith says, any suggestions of opportunities and REITs for the remainder of the year? That's a good question. The big question, of course, is retail, and should we stay in retail? I'm staying in retail. I'm not deploying a whole lot more capital in retail. I think the looming cloud, if you will, in retail today is Sears. Sears Department Store is obviously one of the big names that is questionable whether they're going to survive. I think that it's very likely that Sears may not be around a year from now. We won't know until after the holidays whether or not Sears survives, and I think if they do file bankruptcy, it'll be in the first quarter. Sears has come out and they've been able to sell all the furniture they can. They've sold off the real estate, or spun off a lot of the real estate to Seritage. They sold off a lot of their big well-known brands that are in the stores. They're really trying to create partnerships. They're doing really everything they can to stay alive. And I would say arguably they're grasping for straws. So I believe until we know some clarity with Sears, I just don't think we're going to see a huge bounce back in retail, especially with this Amazon growth that's out there. And Amazon just announced their numbers, and Apple's numbers just came out, and it's obviously going to continue to be the story of the day of Amazon versus brick and mortar. But look, I mean, Amazon's buying Whole Foods. That is certainly a validation that that brick and mortar is not dead, that it's going to survive. So, I would say probably stay away from retail. Communications to me is a great sector. And when I say communications, I like data centers. I like cell towers. I like those companies that provide this technology, which is the wave of the future. So the problem is it's been hard to get those prices because the prices keep rising and rising. I'd love to own American Tower. I just cannot find that margin of safety. So I would say continue to focus on communications. Look for those companies that have those wide moats. I think net lease is just so simple. You can almost always buy a net lease REIT. We've got to buy our own realty income. I wrote about realty income today, ticker symbol O. $57 is our fair value. I would wait on a pullback, but there's nothing wrong. If you bought it today at 57 and you wanted to wait later, that's fine. But I would say always net lease is simple, and again, I'm not trying to hit the ball out of the park. That's not why I write this newsletter, to try to flesh out, hey, I made 25, 30% returns a year. The number one objective for me, and it should be for you, is to protect your principal at all costs. And really, I try to focus on, buying stocks at a margin of safety. they're going to produce very sustainable long-term dividend growth, because we all know the power of compounding today. Bob writes, what's your feeling on Kimco? If you read my article, I think a couple of days ago, I got 5 kids, so you got to don't blame my humor, but I said something like, I love this REIT, and Kimco is its name-o. And so obviously Kimco is, I like Kimco a lot. I like the management team at Kim. That's ticker symbol KIM, Kimco, the largest shopping center in the U.S. They've really done well. They've got a new management team in place. I think Connor Flynn is doing a great job at CEO. He's a young guy, but he's proven to me that he's very capable. And Kimco's done a really good job, moving out of Mexico, moving out of Canada, focusing on the U.S. major markets. They just announced a new shopping center in Portland, Oregon, where my brother lives. It's over $100 million investment, and right down the middle of the fairway for what Kimco's buying. And look, I think Kimco is definitely one of my top picks today in the shopping center space. So thanks for that question. I'm going to switch over to Andrew. What about Apple? Of course, Andrew is not referring to the computers chain, but the hotel, the lodging REIT. Apple's a good name. They're a monthly paying dividend payer. They invest in the limited service hotels. So this is kind of the hotels that I would stay at. I can't afford the big luxury boutique names. Apple's done well. They were a non-traded REIT. They've been able to kind of move over into obviously the publicly traded market. It's a little riskier than some of the other names, just simply based upon their experience in the public space. Their coverage ratio is a little higher than some of the others. Leverage is okay, is decent. Again, I favor Chatham in that particular sector right now, but Apple does pay monthly. We've got Apple in our monthly dividend portfolio, and they've been able to really keep pumping out the dividends. So I'm really feeling pretty good about that. Let's see if we go back here to Artie. Artie asked about data centers. Again, I know I mentioned QTS. I like digital a lot. Fortunately, I was able to get in digital at the right time back in 2013 when Highfields, the hedge fund, attacked digital. I was out there, really trying to maneuver the irrational behavior that we saw in the market. So we got a pretty large exposure in digital back when the sell-off occurred. They've got a great management team, one of the best companies, not only in data but around. I'm actually writing on digital in a few days. I will mention I recently came out with an acronym for the FANG. My daughter works for CNBC, and we always talk about the FANG. So I came out with this new REIT version of FANG called Davos. That's DAVOS. It's in Switzerland. I've never been able to go there, but I want to go there. But I'll just give you a quick. I haven't told my reading audience yet, but digital is the D in Davos. So we definitely feel like that's a name that everybody should have in their portfolio, and I obviously like digital a lot. And I go back to let's see. I answered the rising rate comment for Roy, and I'm getting filled up with a lot of questions, so I'm sorry I can't get them all here. Here we go. Daryl, is Realty Income considered a mortgage REIT? No, Realty Income is an equity REIT. They own over 4,000 individual freestanding properties, one of the safest REITs around, so they're kind of the exact opposite of a mortgage REIT. Good question. And Iron Mountain from Wayne, is it reasonable to hang on? Yes, Wayne, I like Iron Mountain. I would stay in, especially after their second quarter earnings. They came out really strong, and I'm going to be writing on them in a couple days as soon as I can slow down and catch my breath. Top multifamily REIT, AJ. Avalon Bay and Essex, they're just hard to buy. Essex is always expensive. That's ESSS. Avalon would be kind of the next one in line, and then maybe Equity Residential as well. So hopefully that helps. Yes, Robert, I do analyze Canadian REITs. I want to get into that space, and we're definitely, a lot of Canadians love real estate. We know that, and most of those REITs in Canada pay monthly, which is really interesting. Somebody asked, here we go, Don, what is a SWAN versus a SALSA? SWAN, again, is sleep well at night. SALSA is one that doesn't sleep well at night. In other words, it's everything else. SALSA is actually an acronym I came up with, and it's something like lasting, sustainable. I can't remember the exact name. I'll have to provide that to you at a later point, but it's basically we either a Swan or a Salsa, but Swan is the best of the best, or the blue chips. So I'm trying to keep going down here. We've got a couple more, and I'm probably going to get cut off here in a minute. So safest two REITs with rising rates are net lease and infrastructure. Is there a third ranking? You know, besides net lease and infrastructure in a rising rate environment, you know, I would say more diversified. And, you know, healthcare to me is really, you know, somewhat recession-proof. So I would throw healthcare in there, which is really another form of net lease. Most of these healthcare REITs lease, you know, their properties on a net lease basis, but they've got the healthcare, obviously, exposure, which is important. So I would say healthcare and net lease. We've got over 50% of our durable income portfolio in healthcare and net lease. The anchor and the buoy, so the anchor being healthcare and net lease. I think we're out of time here, so I'm going to, sorry I can't answer all the questions today. I hope you'll take the opportunity to look at the newsletter. You know, I'm really working hard for it. We've got a great newsletter business, and I really appreciate everybody listening to the call today, and look forward to hopefully doing this again soon. This has been a lot of fun. Thank you very much.